Okay, this is going to prove probably to be one of the longer ones in the homework series because as I was looking at this, it's kind of hard for me to treat parts 1 through 4 as satellites, so to speak, individuals, because it kind of all connects as one subject matter, because this is all the merchandise accounting we're discussing here. So that's why this is going to probably go on longer than any you've seen. So just kind of might want to just take it in chunks, but here we go. All right, so part 1, again, this is the basic example that we're going to be working with for the rest of this video, and of course this homework presentation as well. Now, this is August 5th when this whole process began. Fortune Company is a wholesaler. They sold $75,000 of merchandise on account to Viable Corporation, a retailer. Cost of the merchandise was sold, that was $40,000. Terms of sale are $215, net $45. Shipping costs $1,000 appear on the invoice sent to Viable. All right, so first we're going to detail the seller's transactions in general journal format. So the first thing you have to understand is who is picking up this $1,000 here. In other words, who's responsible for the shipping costs? Well, again, in this case, Fortune sent it, an invoice that shows $1,000 for shipping costs on it to their customer Viable. Therefore, we know it's going to be Viable that ultimately has to pick up this cost. So when you're looking at this first transaction for the seller, in this case Fortune Company, or Corporation, excuse me, again, we're going to have to detail like how much does their customer Viable owe them? Well, they owe them $75 for the merchandise plus $1,000 for what the cost of the shipping is, so that's why the accounts receivable should be for $76. Now keep in mind, the amount of the merchandise that was sold is still going to be $75, so sales is still at $75. So the question is, what do you do with that extra $1,000? And again, two possible scenarios. One, that's the exact amount of cash that Fortune Corporation paid for the shipping, and they're just passing it on to their customer dollar for dollar. Or possibly this is what they simply charge them, so you want me to label it some sort of like revenue other than. Again, you shouldn't think of it as being part of the sale because it's not. The part of the sale should only equal whatever you're charging somebody for the goods. And here's the rationale for that. If I didn't say it earlier, I don't think I did in the videos for merchandise accounting, but here it goes. Think of it this way. If you're refunding somebody their money upon return, you want to define it in terms of what? Whatever the sale is. So that's really what you're looking at. When you say the sale was for this many dollars and you accept returns, that's the maximum upper limit for that. So that's why you don't want to say this extra $1,000 is part of the sale, because then that would mean what? It would open you up to having to refund them that $1,000. In other words, you said the sale is $76,000. If they returned it, you'd have to give them back what? $76,000. But clearly that's not the case here. This is an extra surcharge on top of the sale. So it should be reflected likewise. So again, either it's going to be this is what we exactly paid for Fortune Corporation, or this is what we're simply charging them for that. So that's why you have to think of it as a secondary source of revenue. Because again, separate from the sale, because it's not going to be included in any refund of the sale. So that's the logic and the rationale for treating it like that. Right now, that's the first part of the seller's transaction. Remember, seller's got this problem. They got to do two things. What's the sale? What's the cost of the sale? So the cost of the sale here is $40,000. So we're going to debit cost of goods sold and credit. I have it as merchandise inventory. That's the same thing as inventory. That's just the old-timey way we used to refer to it. So those are interchangeable. So debit the expense account, cost of goods sold, and then credit your inventory account for $40,000. Now, what's the buyer? In this case, that would be Viable Corporation. What does their accounting look like? Well, it's pretty simple. It's just debit inventory, credit accounts payable. That's it. For what? For whatever the accounts receivable amount was. Remember, these two things have to equal each other. 76 in AR equals 76 in AP. They have to be equal because that's what they got charged, right? The total invoice amount was $76,000, so that's how much should go in AP. Therefore, that's how much should go in the merchandise account itself. Those should always be equal to each other. And we'll talk about that parity issue once again here. And then finally in C, last of the first stretch here, which company owned the goods in transit? So again, how do you determine that? It's simple. Who paid for the shipping? Viable did. Therefore, Viable owned it, and that means even though it didn't say expressly, the terms were FOB shipping point. So again, they owned them in transit, and again, what are the ramifications of that ownership? Being the owner means that what? They have the right to indemnify themselves against a loss by insuring the goods, meaning they have that insurable interest I talked about. If they failed to do that, they would open them up to losing the $75,000, meaning if they got lost in transit, it was nobody's fault, they would still have to pay Fortune Company Corporation the full amount. That would be the reality of it. All right, so that's the first part here. Oh, excuse me, I'm just rearranging myself in the chair here. A little sore. I'm post-op right now, just so you know. I had a hip replacement, so, still dealing with a few issues, but not too bad right now. All right, part two. So what's going to happen before the payment within the discount period, usually these are pretty predictable, that's the way they work. On August 10th, Viable is going to return $10,000 of the merchandise to Fortune. Upon return, Fortune inspected the merchandise and determined the cost of goods returned was $6,000, but of that amount, only $5,000 was still saleable, and they cannot recover the cost of the spoiled goods. So first, what do the seller's transactions look like? So once again, we're talking about Fortune Corporation. So first, what was the amount of the return? In other words, the invoiced amount. So that's going to be the 10. So for that, we're going to use a specialized account called Sales, Returns, and Allowances. Remember, that's a contra revenue. So you're going to debit that, and then you're going to credit that $10,000 out of AR because your customer doesn't owe you that money anymore. Right, so that makes sense. Now, the big question is, what's the amount that we should restore inventory? Remember, the amount returned was 6, but only 5 was viable. So the rule is always going to be what? Whatever you could reasonably still sell goes back in inventory. So it's only going to be the 5,000. So debit merchandise inventory, same thing. Credit the cost of goods sold for the 5,000. Now again, the thinking here is, because I often when I cover this, people are always asking me, what's happened to the other $1,000? And the answer is, it's embedded in this number here. When you originally wrote off inventory as being sold, it's included in that. So it's already been expensed. In other words, no need to worry about it. It's already become an expense of doing business from the original sale. Therefore, just leave it there. We don't need to do any special accounting because it happened to spoil. That's meaningless, because keep this in mind. When you do a year-end count and you have that spoilage issue, remember, and you have your discrepancy, so you have to write inventory down. Guess what account we write it down through? Cost of goods sold. So since that's the normal treatment for spoilage, it's already embedded in your cost of goods sold as it happened there in the first part of this homework. So just leave it. There's no special action you need to take. Just reinstate the 5 back in inventory and just take 5 out of cost of goods sold. Everything it takes, you're done. There's nothing else to do there. All right, so that was the seller dealing with the return. How's the buyer going to handle the return? It's pretty simple. The only thing they care about is the 10, right? That $10,000 is what they want charged out of their AP because they don't owe that anymore, so they debit that, and they're going to take that $10,000 out of their inventory account. The end. There's nothing else that they need to do there with regard to the transaction. And remember, there's no way of discriminating a return versus an allowance from the buyer accounting, because this is how the transaction would look in both instances. It would just be 2 lines. But in the case of the seller, you can tell, because if it's a return, you'll see 4 lines like we have here. If it's just an allowance, you'll just have these 2 lines there. Right, now C is an important concept that we'll go over again here. Should these 2 companies exchange information regarding the value of the returned goods? And the short answer, of course, is yes, they should. Remember that idea about credit memoranda, the credit and debit memoranda? In other words, the seller should say, we're crediting your account receivable $10,000. Likewise, the buyer says, we're debiting our account payable with you $10,000. So that's the way we have a credit memo and a debit memo, respectively. And of course, why are we doing that? So that both parties agree to the value of the return. They both say, oh, we know it's this much money. Again, we have to have parity between AR and AP. Those amounts have to match. Both companies at this point in what we're doing here in this exercise, both should have a balance of exactly how much. 76 minus 10 equals $66,000, right? The original amount was 76 minus 10, 66. And we have that under what we're observing here. Again, if there was some problem, one company disagrees with the amount of the return, then they can begin to do what? They can have, go through some sort of arbitration or whatever, however they want to arrange it, whatever they need to do in order to get on the same page. They can begin that process of ironing out the discrepancy so that they don't do what? So that they don't, sour the business relationship, because maybe they want to keep this going because it's a good thing for both parties. That's the importance of exchanging information on returns. and allowances. Doesn't matter what we're talking about, either one of those. Right, now part 3 deals with paying within the discount period. So that would have to be by August 20th, and that's what we observe here. Right, so we're going to go through and figure out, like, where is this cash debit or cash credit? Doesn't matter which half we're talking about, seller or buyer. Because remember, these two transactions have to be the same 3 numbers, just used differently. Okay, so where are we getting $64,700 from? All right, so step 1 is just step through what happened here. So we had 76K as the original, minus 10K returned, equal an outstanding balance of 66,000. Now, the thing to keep in mind, though, when you're applying that discount, right, that discount is right here. So we'll go over, what does that mean? 2% discount if they pay within 15 days, so by the 20th. Otherwise, the net amount is due in 45 days from invoice, which in this case would be August 5th. So 2% discount. So what are we going to apply that to? Well, remember, this balance of 66 also includes what? 1,000 for shipping. So the best thing to do is just back the shipping out. In other words, figure out what the discount is on the 65K. Right, so 65K times 2% will get you exactly $1,300. And again, there's our discount right here. Now remember, we're dealing with the seller accounting. We have a special account to deal with sales discounts, so we're going to put that $1,300 there. So if we subtract that out, we'll get 63,000. I got to go to the full form here. $700 is what's being paid for the goods, and then now you want to add that $1,000 back in, plus $1,000 for the shipping, equals 64,700. So that's where that 64,700 is coming from. They paid, in other words, think of it this way: they paid 98% for the goods. Remaining amount cost of the goods is 65,000, plus 100% of the shipping. So we expect, as the seller here, to get paid $64,700. The other $1,300 will write off as a sales discount, and that is in satisfaction of our full AR balance of $66,000. Now, so the buyer is going to use the same 3 numbers, but this is how they'll look here. So they're going to write off their AP, 66. They're going to pay cash, 64,700. The math is the same as what we just calculated. Here's the difference. How do they handle a purchase discount? They're going to subtract that from your inventory account, $1,300. So in other words, if you take all the steps here, in other words, the initial amount of the transaction for them was 76. They returned 10, and then they subtracted 1,300. That almost looks legible. That means the total amount that they remitted was 64,700. And guess what? That same math is going to apply everything I said there to the change in merchandise inventory. It started here. We took 10 out from the return. We took 13 out. That, again, this was the purchase return. This was the purchase. This was the purchase discount. So we get the same 64,700 change in merchandise inventory. It increased by that much, and that equals our cash payments as well. Remember, you have to have parity in those. Because why? Because, again, this is going to be truer in the next chapter, the next homework, which is when we switch to thinking in terms of units. What did we pay for each unit? And now we can take that $64,700 in merchandise inventory, divide it amongst all of our units in inventory, and figure out what we paid for each individual unit. Again, there's a lot of important things that are embedded in understanding unit costs. And the big one is, what's your margin per unit? In other words, what are you charging for each unit? Your selling price minus what are you paying for it? And that difference there is usually referred to as your margin. That's how much that is each unit contributing toward the payment of other expenses above and beyond the cost of the goods themselves. All right, so that's number 3. Again, that takes us through basically the whole transaction from inception to completion. Purchase or sale on account, a return of a sale or a purchase on account, and then payment within the discount period of both receipt of payment or payment by the buyer within that time frame. All right, now number 4, this will take us to the end of this first video, so not too terribly long actually. We're going to change one little fact here. What if the invoice says no charge on the shipping line? How does everything change in parts 1, 2, and 3? All right, so part 1, transaction 1, as I refer to it here, would change like so. So it'd just be accounts receivable debit sales credit for $75,000 instead of $76,000. Because remember, what's going to happen to that $1,000 for the shipping charge? It's going to get booked to delivery expenses, debit, cash, credit, or I can also say you could put it in accounts payable. Now, this could be a lesser amount if the $1,000 you charged your customer wasn't what you actually paid out of pocket. Maybe it was some lesser amount, and again, so that's what you would book here. In other words, that's going to the notion that this is some other form of revenue. So your actual costs, let's say, were only $500, so that's what you would book here: delivery expenses, debit, cash, or accounts payable, credit for the $500. Whereas in the instance where you were asking your buyer to pick it up, you'd have $1,000 of some sort of secondary revenue generated from the sale. And so that's what's going to be the change in the seller accounting. Again, how's the buyer accounting change? Merchandise inventory is only debited, accounts payable credited for the $75,000 because again, those shipping costs are nowhere to be found. And again, implicitly, what does that mean the shipping terms were here? That means they were FOB destination, meaning it was free to the buyer because the seller had to pick up the cost in this case. Good news is no change in transaction 2. Again, in other words, the return looks the same as it did in the original example. And how is the third transaction or set of transactions going to change? Not really that much. You'll notice, again, if I go back here, our computation for the discount was right here, $63,700. We're done because there's no shipping. So that's why you're seeing that amount appear here. In other words, that's how much would be paid for the goods, 98% for the goods, and there's no shipping involved. So therefore, in other words, that other $1,000 is just missing. It's minus $1,000 here, minus $1,000 here as well. And of course, you'll see the same thing is true on the buyer's books. Their AP is down $1,000 from the original example, and of course, the amount they remit is down $1,000. But guess what's the same? The sales discount and the purchase discounts. Those remain unchanged. And our parity rule is still true here. In other words, the amount paid originally for the goods was $75K. They returned 10, and then they got I did the 3 before the 1. Now it looks like a B. Oh, I was doing so well there. At least that's my opinion. Minus the 1,300 equals our 63,700. Again, that's what we paid cash, and of course that's also how much our inventory account went up by as well. Again, still maintaining that parity. All right, I guess it wasn't too terribly long. Longer than most of them have been, but not that long. All right, so again, feel free to go back over that to review these concepts at your leisure. So I'll see you in part 5 of the 4th homework set.